So first of all, just need to go through our disclaimer with you. Trading involves a loss of risk of capital. Trading is not suitable for everybody, although as usual, we hope it is for you. Many companies provide leverage, so just be aware you can lose substantially more than the initial investment you make. The news, opinions, everything contained in this is just purely for educational purposes. We are not trying to encourage you to trade or invest. That has to be your decision. And of course, you should carefully consider the risks involved, your financial situation, definitely your level of experience and your risk appetite. And of course, you should only risk capital you're prepared, but more importantly, that you can afford to lose. Any doubts whatsoever, seek independent financial advice before risking your capital, please. Okay, so last week, yeah, so much went on, especially from the central banks. Not so much data-wise, but definitely from the central banks. So it was all about them, and they certainly did not disappoint. Many increased by 75 basis points, but we did have a 1% from Sweden, 50 basis points from the Bank of England, and nothing from Japan or China. Even the Swiss hiked by 75 basis points, which took them from negative 25 to a positive 0.5%. Data remained weak. Well, it wasn't much out, but what there was, and again, it's not really surprising with all these rate hikes. The USD continued to strengthen, driving the euro below par to the USD again, and the GBP, dropped below 110. These levels have not been seen for a long, long time, decades. And I'm a big fan of the dollar, and I have been for at least the last 2.5 years. But it's possible we could see a little bit of profit taking coming in soon. That doesn't mean it's the end of the dollar. It just means that, as I say, just a little bit of profit taking while everybody takes stock and works out what's going to happen next. Japan had to threaten to intervene on the yen to sort of give that a little bit of buoyancy, but the dollar's just still so strong. Of course, stocks had another bad week, ending on the lows. Gold too sort of followed stocks lower, trading below $165, and oil dropped below 80. Now, I do expect, obviously just from reading and all that, I don't know, that the US will replenish their strategic reserves around these sort of levels below 80. Of course, we'll have to wait and see, but there is a really strong chance that they will do that. Okay, so key data for this week. Now, there's a lot of central bank speakers this week. Let's be careful how I said that. And of course, we're going to hear from their views on what they've done already, and what's coming up in the coming months. What they expect, and of course, all the focus is on inflation still. So in the US, we've got plenty of data this week. Watch out for consumer confidence. I've watched this really closely, consumer confidence. We account for up to 70% of an economy. So obviously how we feel about, our earning potential, what's around the corner for us as individuals and as households, family and friends, is going to impact the way that we spend. Now, we're obviously seeing higher prices. We've had less disposable income from food, energy, and such like. But the fact is that with all of this rate increases and all that, we're getting less and less to be able to spend. Now, that's why I like consumer confidence, because if we're not confident, we hold back. We don't spend so much. And of course, that's important, especially when, as I say, that we account for so much of an economy. GDP could be negative again with US already in a technical recession. I mean, for me, they've still got the strongest economy, but technically, you could say they're in a recession. Maybe we need to change economics and what the criteria is that says someone's in a recession or not, well, countrywide. But don't be fooled, you know. Demand is still there in the US, and as I say, they do have the best economy. Now, PCE. So this is one of Powell's main metrics, and because of that, you know, basically it's more stable, it's more reliable than CPI. So PCE is the personal consumption expenditure. Of course, it's a price index, but what we're looking at, are consumers spending more now short term, or are they holding back and saving more for the longer term? And you know, that's why the Fed likes that so much. In the UK, not too much out, but we've got housing data, but eyes will be on the GDP, obviously, to see if we're entering a recession for sure. I'm based in the UK, so that's why I say that. Truss has sort of cushioned it, cushioned the blow, I would say. They've just done a mini budget with some tax cuts and, of course, the power caps. You know, inflation is higher. I would still expect it to go a little bit higher yet, and then to drop back. But you know, that's only sort of my personal view. In the EU, we've got the HICP, which is effectively a CPI. We're looking at the change of prices there, you know, goods and services. But, you know, always watch for the core change. You know, don't focus so much on the headline, but much more on the core. That's the one that pro traders look at, because that's got the more consistency to it. And, you know, it takes away the tobacco, the alcohol, energy, and such like food. Retail sales, and then of course consumer and industrial confidence, which I would expect to be remaining low still. From Germany, we're going to get IFO, and of course that's for the business sentiment, in case you didn't know. And they survey over 7,000 businesses to get that data. And also in Germany, we're going to see retail sales and the CPI preliminary. You know, the EU is still trying to create this sort of energy cap. Some countries want it just for Russia, other countries want it to cover basically everywhere. So, you know, there's still arguments going on there. So, you know, it'll be interesting to see what the result of that is. Hopefully it won't take them too long to come up with something though. There's a little bit of minor data coming out, PMIs and such like in Japan, industrial production, retail sales, China PMI and manufacturing, and Australia retail sales. So I've added in the dot plot here. This is sort of every other meeting. This is what comes out after they have the FOMC meeting. Now, each one of these dots represents a member of the committee. You don't know who it is, but you can see from it the shape and the expectations going forward. So the dot plot there is leading up towards the end of the year on the left, the first block. And as you can see underneath the years, so the next one is 2023, the next one is 2024. So next year you're expecting rates to stay high. The year after, you know, the Fed's very mixed when you look at those, you know, the range there is incredible. It's like 2% between the highest and the lowest there. So some are expecting by 2024 that those rates are going to come down, some much more aggressively than others. And then 2025 for them to be a bit lower and to hold there, and then going further than 2025 to have sort of balanced out around there, you know, around the 2.5-ish level. But obviously things can change very quickly in the markets and economics at the moment. So, but I just thought it's interesting for you to see that if you're not familiar with it. Okay, moving on to the macro. Of course, inflation. So it's still the devil as far as central banks are concerned, and to a degree even us, the consumers. Although it is slowly dropping, which I expect to see start to feed into the PPI, but I don't expect it to be seen in CPI as quickly, because companies are simply increasing their profit margins even more while they can. Stagflation, that remains sort of this pre-recession condition, if you like, I think. Again, just my view. And for those of you that are not familiar, it's basically inflation but without growth. Recession-wise, as I keep writing in my daily newsletter, mentioned in our YouTube, central banks are prepared to create recessions by increasing rates and keeping them high. So don't expect them to come off anytime soon. They're not going to reverse policy quickly, and they will not stop until they have inflation under control at constant 2%. That doesn't mean they're going to keep increasing rates and rates and rates and rates, but what they're going to do is they're going to get them to the point where they feel that it's at a level where it's starting to reduce demand. That's the only part of the economy that they can try and manipulate and control is consumer demand. So in my mind, what they're trying to do is destroy that. And then once they've done that, that's when they can start to rebuild. We still have some supply chain issues, although again they're still improving. So we have seen quite a good recovery in all different directions since COVID, and obviously since Russia invaded Ukraine as well. And that's pushed oil back below $80 for the moment. Now, of course, the main risk is that China's zero tolerance for COVID, which has resulted in over 20 cities going into lockdowns. Now, of course, if there's any new increases in those or any new cities where they're finding that, or, of course, any mutations that come along, that could again come back and endanger supply chains, especially from China. The Russia-Ukraine war continues, 7th month now. Who would have believed it? And of course, Russia now is calling up 300,000 reservists, if you can call them that, volunteers. But many of them are very reluctant to go and are even trying to leave the country rather than fight. And of course, Putin holds what he considered by governments around the world to be false elections, referendums, if you like, in the captured states near to the Russian border to make them part of Russia. And of course, last week he also threatened the use of nuclear weapons, I believe. Now, energy prices are well off the highs. We see them up to about 130, and here we are down at 80. And it's just really a matter of rebalancing there, I think. Europe's finding alternative sources to replace Russian energy, apart from obviously Russia turned off the gas taps. And Russia is exporting more to China and India and other countries that are prepared to take it, especially because of the discounts. And by the end of this year, Russia will have completed its new pipeline that goes into China for gas. Now, generally, because Russia offers that discount, it is attractive to countries, and you can't blame them for taking it for sure. But by that happening, it does release other countries' suppliers to sell to those that have got sanctions against Russia. So it's just people moving around, or countries moving around who they trade with, who they buy from. Really, supply and demand hasn't really changed that much. And of course, that weakness in the oil is where people are getting more concerned about demand again, because if these rates keep going up, if consumers have got less money, they're going to do less, they're going to go out less. And of course, if there's less transport needed in all different, whether it's industry or whatever, then that's going to reduce the demand. So that's becoming a nervous factor as well. With food prices, they've also dropped, but again, the weather is now again becoming that key impactor. And we have La Nina that becomes active. It's been active all this year, which is why we've seen these extremes in weather, and that's going to remain into next year as well. And that just does turn the sort of the weather topsy-turvy. And I believe that workers are beginning to return to work, and companies will, of course, soon be withdrawing some of those jobs as the risk of recession grows everywhere. Of course, we're just finishing September, so we're soon going to see third quarter GDPs, which will be really interesting. Now, next Tuesday, this Tuesday coming, the 27th, I've been asked to appear on Ninja Trader. They do these trader workshops where we discuss various things. So they want me to sort of give a brief outlook, brief idea of my career so far. It's only 50 years so far, so but let's see where, for that. I'm going to be brief on that, otherwise that'll be all the 45 minutes gone. And then we're going to talk about the macro outlook, and we're going to analyse a few markets as well. So I've put a link there just in case you want to come along and listen to that. It's only 45 minutes and it starts at 5 o'clock UK time on Tuesday.